Equity markets have had a tough start to the year with policy uncertainty, inflation concerns still lingering south of the border. But as we head into another earnings season, what should investors be focused on? Joining us now to discuss is Jeff Evans, VP, Director and Lead of Empirical Research and PM Support at TD Asset Management. Great to have you back on the show, Jeff.
Excellent. Great to be here. Thanks for having me on.
All right, so we're not that deep into the new year yet, but it's been a bit of a bumpy ride for equities, bond yields moving higher. As we take a look at the bigger picture and what the footing that we're on at the start of this year, what is going on out there?
Sounds good. So it's another interesting start to the year. And I think one of the things that I really like about a new year is that we also get a whole new set of earnings estimates out of the sell side. So as you kind of flip into a new calendar year, analysts update their models, you generally get that extra year of earnings estimates. And for people like me that like to dig through all those numbers, it's kind of an exciting time to get a sense of what the market's focused on, what some of the new trends are, and pockets of consensus is looking into. Already had a pretty good sense of the data for 2025 and 2026. Those estimates have been around for a while. The new data point now is 2027, so just get that little glimpse into the future.
That's really forward-looking, yeah.
Exactly. Usually, whether it's accurate or not is a different story, but it gives us at least a sense of what the sell side is thinking about and how they're analyzing some of the macro trends. Before I get into that, maybe just to set the longer-term context, over the very long term, if you look at a 20 or 30-year time frame for the U.S., a typical growth rate for earnings in the U.S. would be about 6% per year. That's basically 4.5% GDP growth plus a little bit of financial leverage gets you up to that 6% in a typical year. Zero in on the last 5 years, we've actually seen earnings growth accelerate a little more, up to about 8%, which is maybe a little surprising because we had a huge dip in COVID, but then we had a lot of fiscal stimulus, a lot of monetary stimulus, and of course a little bit of inflation to kind of help juice earnings growth over that long-term average. So in the last 5 years, we've been running a little bit hotter. And then in the last 12 months or so, we've had another new theme come into the market with AI, which has helped boost earnings growth even further still. So in 2024, saw earnings growth just shy of 10%. So kind of this pattern of 6%, moving to 8, moving to 10. That started off with a lot of the traditional tech stocks. There's the NVIDIAs, the Microsofts, all the big companies that are building this AI and deploying it. But what we've been seeing is that that's actually now starting to broaden out and starting to see stronger earnings growth trends across a lot of the other sectors in the market. So whereas in 22 and 23, it was very focused just on the Mag 7, starting to see that broaden out to a broader part of the market. Now, what's interesting is when we start to look at what the market's expecting for 25, 26, and 27, that long-term 6% earnings growth is just completely thrown out. Boring, the market's basically ignoring that.
Doesn't get anyone's attention anymore? Just 6?
Too low,
yeah.
It's just 6. What the market's doing is it's focusing on the growth rate, so that progression from 6 to 8 to 10. In 2025, consensus estimates today have 14.5% earnings growth, more than double the long-term average. Market's expecting about 13.5 in 26 and another 11.5 in 2027. When I started looking through these numbers a few weeks ago, what I was really hoping for was that you'd see some conservatism from analysts, maybe a little recognition that mean reversion was going to kick in and we'd get back to that 6 to 8%. They've done exactly the opposite, stayed very optimistic. And I think the key thing is, over the long term, earnings and GDP growth tend to be pretty correlated. Right? It's really hard for earnings to grow faster than GDP, maybe for a year here and there, but over the long term, they tend to stick together. You don't normally see 4 or 5 years back-to-back double-digit earnings growth. So we're in a really interesting position right now where the market has some pretty optimistic expectations on earnings that don't necessarily make sense based on what we're seeing on broader macro trends. A lot of the GDP growth expansion that we've seen in the last 5 years was because of fiscal stimulus, because of monetary stimulus and inflation. We're on almost the opposite side of that today. The market has priced out almost every rate cut this year in the U.S. The Fed maybe will do one is kind of the current expectation of markets. So we're not going to see monetary stimulus driving GDP growth. Inflation is still running a little bit above target, but is nowhere near what it was in 2022. So we're not going to see inflation being a backdrop for earnings growth. And then on the fiscal side, we're running a 6% plus deficit at the federal level in the U.S. And the federal government has to fund that at 5% bond yields. It's just not sustainable for more than a couple of years if they're not able to get their debt to GDP back on track. So the ability of the Trump administration, they're saying a lot on what they want to do to boost the economy and add stimulus. The actual ability to do that without upsetting the bond market and creating some challenges is it's a significant problem for them. And so when you look at that gap between GDP growth that probably has to go back to more like 4 to 5%, 14% is an aggressive number, and it's getting to the point where it seems maybe even a little out of line with what the economy can actually produce over time.
Maybe a little bit too much optimism out there. With that as our backdrop, it's a fascinating backdrop. We start taking a look at the sectors. What's looking interesting in this environment and perhaps what's not looking as interesting?
For sure. So the interesting thing is it's actually still tech stocks that would be right at the top of our radar. When you go through all of the different sectors in the U.S., particularly the big six or the Mag 7, you're seeing about 20% earnings growth expectation in 25, a little bit, roughly that level for 26. 2026 as well. So that's where the earnings growth is. That's also where the profitability is. A lot of these big tech companies are very profitable, strong balance sheets. So in a lot of our empirical models, they continue to screen quite well. And what's very important for us is you continue to see pretty strong earnings revisions for that group. So yes, the growth expectations are lofty, but the market is still moving higher, seeing stronger earnings revisions over time. And what'll be interesting as we go through the next couple of earnings cycles is going to be, it'll be to see if companies can actually deliver on those expectations and if we continue to see higher earnings revisions over time. But at least for the time being, big tech still looks interesting. With that said, a lot of our sell models also suggest that there's pockets of the IT sector that are at risk. So it's a bit of a bifurcated sector with the Mag 7 still doing quite well. A lot of those are driven by GPUs and AI. What we're seeing right now is that the more traditional CPU manufacturers, the Intels and the AMDs, very, very different story for them. Intel has been a very significant, unfortunate story that they've lost a lot of market share. Earnings revisions are quite negative, and they're very much on the opposite end of the spectrum from NVIDIA. So those companies would be screening relatively poorly for us. And then a lot of the companies that feed into that, the semiconductor wafer manufacturers, the testing companies, all the companies that are involved in kind of feeding.
Those picks and shovel plays for AI, right?
Exactly. A lot of those as well, kind of coming into the same thing and screening poorly.
Okay, let's talk about a little bit about your coverage here, infrastructure and real estate. We'll be taking questions about that later, but how are you seeing those places?
So if you look at them from an earnings growth perspective, historically these sectors produce about 6 to 8% earnings growth over time. Real estate still has a few interest rate headwinds that they're working against. It may be a little more like 4 to 5 over the next year. If you put that up against 14% earnings growth, not competitive. So we'll see how this year plays out. But what I think is interesting to note is if you take a 5 to 10 year view, the visibility for earnings growth in infrastructure and real estate is far higher than it is for the broader market. So that 6 to 8% earnings growth might be low this year, but if you compound that every year for the next 10 years, that's a pretty healthy rate of earnings growth over time. And then bear in mind, the market normally only does about 6% earnings growth over time. So if you start to see some mean reversion, if we start to see some cracks in the broader equity market and companies not missing or not actually meeting these lofty expectations, that's the environment where real estate and infrastructure start to come back and look a lot more interesting and exciting. The one thing that we always remind investors in these sectors is that it's that long-term visibility that creates the value. A lot of these are regulated utilities where you know for 4 or 5 years from their rate cases what the earnings growth is going to be. In the real estate sector, you have generally long-term leases and contracts that backstop this. And what that does is it leads to lower volatility. So these tend to be much less volatile than the broader equity markets. And they also tend to be much less correlated to broader equities. So I think if you put everything together, we have fairly lofty expectations for earnings. Market is trading at 24 times, which is pretty high. And we have one of the most concentrated equity markets in history, with the largest stocks comprising well over 30% of the US equity market. That's an environment where real estate and infrastructure make a lot of sense for diversification and risk reduction. So I think the main thing to keep in mind is if we start to see a couple of cracks over the next few quarters, that should help real estate and infrastructure. And then the last piece of this is interest rates. We've seen a big move in the 10-year bond yield since that Trump started to see a good chance of getting him into office, and then ultimately after the election, bond yields have gone up sharply. If we can get a little bit of clarity on what they're thinking on the policy side, that should help at least stabilize bond yields. And then ultimately, as we continue to see inflation stabilize and come down, that creates a nice entry point for the sector as well.